I'd like to start by asking you a question. You don't need to answer, just for yourself. When did you last had an in-depth discussion with the procurement director of your company or people in procurement to have an in-depth understanding of what they're really doing on the field? From experience and from the companies I've been working with over the past couple of years, the answer is very often, well, that's quite a while. I believe that treasurers are very well placed within the company to create change, to challenge the status quo. I believe that in times during which companies are very often looking for additional pockets of savings, treasurers are very well placed to deliver these pockets of savings if they team up with the right person in the company. And I believe that there is more value to be extracted from the link between people and from the relationship between them than from the individual themselves. So I think that it's time for lots of treasurers who are dealing with their day-to-day job in a traditional way to get out of their office. It's time for lots of treasurers to team up with procurement and to try and understand how the risks are born, to see the birth of a foreign currency risk, to see the birth of a commodity price risk through a commercial negotiation with a supplier. And I think that's extremely interesting because very often we are lacking that view and we're just relying on some reports, cash flow forecast, and we're taking our action on that basis. And I think it's probably about time also to open the debate with the sales side. To which extent your salespeople are able to get a pass-through of the foreign currency price risk within the cost base with their customer, depending on your competitive position. And that would be a natural offset to your foreign currency price risk if it doesn't change your competitive position. So I think it's time to stop the theoretical approach, managing through spreadsheets only, and it's time to really start speaking to people within the organization on the procurement side, on the sales side, on the production. And it's for all these reasons that after 12 years in banking and corporate treasury consulting, I've actually started to shift and started to speak to other departments in the companies. I felt that majority of the treasurers are actually quite well equipped to deal with the standard matters of treasury, foreign currency risk, interest rate risk, credit risk. But that many other departments within corporates are actually lacking these competencies and would usually benefit from getting these competencies that treasurers do have. A couple of years ago, about 5 years ago, I received a call from the chief procurement officer of a large food and beverage company. And he had two challenges. He had two huge projects. One was the centralization of procurement activities by setting up a buy-sell model, central procurement of all the goods within the company and resell internally to all the business units at an internal transfer price. The second project was how to basically leverage on this central procurement team in order to better be able to execute commodity hedging. So with my treasury background, I came there and we basically started discussing swaps, options, forwards, futures, the standard treasury toolbox that we usually apply. And then we digged a little bit deeper. And then we started interviewing all the people who were on a daily basis negotiating with the suppliers. And we discovered a world of complexity which was completely unexpected. And that world of complexity that was completely unexpected was due to lots of different factors. The first one is that when you deal with a procurement entity, they buy direct goods, which create directly a commodity price risk, because that's going to be the main topic of the day. They deal with direct purchase of raw materials. So you have a direct identification of your risk, all simple, all good. But very often you buy semi-finished products in which the risk is being indirect, a little bit more complex. And then if you continue speaking with the category buyers, you discover that very often the commodity prices are not explicitly stated in the contract they sign, but it's just being negotiated. It's part of the discussion which they have with their suppliers. So in a way, it does influence the final price you're paying for the goods that you're buying, but the relationship is not one-to-one. It's not a direct relationship. It's not an explicit relationship. It's indirect and implicit. So it creates a direct challenge in order to detect these risks, because you need to speak, you need to understand what these commodity buyers are doing, what these category buyers are doing, what they are buying, what are the market dynamics of their market, and then you need to quantify to which extent the price risk that is within what they buy ends up in your procurement price. Then we head to the dimension of complexity. These category buyers, they're doing a pretty good job in negotiation. But they, very often without knowing it, are applying a series of tools and techniques which are risk management techniques. Just to name a few, if you're buying something, whatever good, a pen, a table, semi-finished good like an aluminum can or whatever component to build an electronic device, you might sign a yearly fixed price contract, in which case you've eliminated the volatility for 1 year, but during the next negotiation round, you will have the full volatility because you'll open the negotiation again. You might have a price which is based on an index, and that price will be based on an index. That index might be liquid, hedgeable, not hedgeable. It might be an index which is not even tradable, for which there is no forward market. You might have the possibility to click the contract, like it's very often the case for energy transaction. You might have a supply contract with your energy supplier and the ability to give him a call and say, on the basis of the current forward price, I'm locking in the price. You might do arbitrage between different supply contracts that are using different pricing mechanism, and you transfer the volume from one contract to the other to optimize your price. So there are lots of techniques, and I'm just naming a few, which are used on a daily basis by category buyers within procurement department. But these techniques and these tools are very often very dependent on who's executing the transaction, who is doing the negotiation, and very often from experience not harmonized, not streamlined, and not governed by any policy. But in essence, if you think about all these techniques, price fixation, negotiating a contract with a physical supplier with a cap and a floor, they have exactly the same economic impact than a lot of commodity derivatives you could enter into with a bank, a forward, a future, or a collar, for example. It's just that they're embedded in contracts and very often just not detected and not managed properly. And what we find out is that there is usually in these procurement departments a very low level of transparency on these commodity exposures, which are either indirect or even implicit. So actually the process for assessing the opportunity to enter into these different types of instruments is also not there. A buyer will usually act by habit. And then I have another question. Would you feel comfortable going out on the field and starting negotiation with your company suppliers in order to define pricing terms, quality of the goods, the functional specification of the goods that you buy? Probably not, because it's not your job. So why are we asking category buyers to start negotiating pricing formula, which are the essence of the risk profile of the company from a commodity risk management perspective? The question is, why are we asking these people to pollute their focus and to distract them from being focused on getting the best deal at the best price with the best pricing terms, the best quality, the best service, and we're asking them to also manage the commodity price risk. And that's where treasurers have a significant role to play. And their treasurers can really add value. Like, for example, in one of the companies I've been working for recently, they have decided that this dedicated commodity risk management team would come along with the buyers in order to deal with the part of the negotiation that was dealing with the pricing formula and the definition of the exact commodity index that would be used. They've issued guidelines, they've trained the category buyers to get a better understanding of the impact that it might have. And the result thereof is that they were, after a few years, because you have to wait, it's a long-term process, you have to wait for contract renewals, etc. After a couple of years, this company has ended up with a streamlined exposure. They have reduced the number of indices to which they were exposed to. They have a much better view on the exposure that they have, and they have selected these indices in a way that allows them to add a couple of new tools to manage these risks. Like, for example, if they select a liquid index for an energy exposure, it will allow their treasury department to place some financial hedges in order to manage the risks. So another item that Treasury has brought in, or risk management team has brought in when teaming up with procurement, is adding a level of control in these companies. Because when a buyer is executing a contract at fixed price, he's actually engaging the company very often at a certain price, but also for a certain volume. When you do that with a derivative, if you enter into a forward contract for, say, whatever, oil, you will follow up that contract. You'll calculate its mark to market. You will follow up the credit risk that you have towards the bank. In procurement department, this is very often just not the case. They are not equipped with the same tools, and they don't have the same techniques that a usual treasurer does have in order to follow up their financial risk management. So that's where really teaming up between treasury and procurement can add value to the procurement department and can also extend the scope of the treasurers. So it boils down, all these projects are finally boiling down to setting up an appropriate toolbox. Majority of the tools that procurement departments are using are already in place in lots of companies. All these different types of contracts that they can conclude on the physical supply side already do exist. It is just a question of formalizing it. It is a question of facilitating it, and it's a question of making sure that we leverage on the best tool at the best moment. I've been working for a glass manufacturer a couple of years ago, and that glass manufacturer has set up, for example, very recently, a standard process that defines that each time there is a gas purchase in order to fire the float in which the glass is being produced, both procurement and treasury are giving at the same time the same call to get to know at which price the gas can be fixed, either with the gas supplier or with the bank through a gas swap, for example. And they're saving millions on that, just by implementing that very small additional process where treasury and procurement are teaming up. There are lots of other benefits that we can name, like, for example, if you add a portfolio of financial derivatives to your procurement operation, you are disconnecting the physical side of your business and the security of supply from your financial side and the price fixation. So you allow, and you're giving an additional weapon to your buyer to have a better negotiation power with their suppliers, because they can stop a contract while knowing that the price is already locked in for the future period. So there are plenty of other. You can eliminate portion of the cost of hedging at supplier side, because you say, no, pass me the risk. I'm hedging it on myself, on my own. You can also streamline your hedging operation. If you're just relying on what the fixed price of your negotiation will be, basically you're handing over the risk management of a commodity price risk to your supplier. And if you have several suppliers, they might all have different views on these markets, and you might end up with a completely blurred picture of how the risks have been managed. If you internalize this process, you will make sure that basically these are your views which are being applied on the market. And we can go very far. We were discussing earlier in this talk the fact that we have direct exposures, we have indirect exposures, we have explicit exposures, but you can also look through the cost structure of your supplier himself, and then you can go very far. But one thing to keep in mind is that we need to be aware of where the risks are stopping and what time lags are taking place in the chain before the risks are reaching you. So if the chain is very long, of course, there is a chance that the risk gets diluted and hits you with a certain delay, which will also decorrelate you from the market you're operating in. I'll try to end quickly so that we have a bit of time for the questions as well, in case there would be some. But basically, I think that in the past, we've seen some companies engaging into commodity price risk management projects, teaming up between their treasury or risk management team and their procurement team, just when these risks were representing a very significant part of the cost structure, like a metal smelter, which is exposed on the buy side and on the sell side as a dedicated team. That seems obvious. But now we're seeing more and more fast-moving consumer goods companies engaging into this similar type of process, whereas the total raw material and commodity exposure on their total cost structure is about 20 to 30% only, and spread across a wide range of commodities. So this might be today the early adopter of a new way of working between procurement and treasury. I think they're definitely ahead of the game. So I think it's a challenging time, because it's all new for lots of treasurers. It requires setting up in-depth process to understand how the business is changing, to understand how the procurement is actually executing its job, but it can deliver hard benefits to the company as a whole. And I think that the treasurer has a key role to play and a key position to take in this process. And I think that this was an idea worth sharing with you today. Thank you.